Welcome to the daily update, where I'll go over the action in the market for Wednesday, December 27th, and then we'll see how things look for Thursday, December 28th. Had another incrementally higher day on Wednesday. We're getting even a little bit more overextended to the upside. We're still positive, and we're in a positive seasonal time. We're having the Dow and the NASDAQ 100 hitting another new all-time high. We're not quite there yet with the S&P 500. We're wondering, is that going to happen? If we go back up to that point on the S&P, is that going to provide overhead resistance? Because the market is well overextended to the upside. If we get up there and start to come back down, is that going to turn things into a pullback type of situation? Pure speculation of that at this point, just something to watch for. There's also something else that happened in Wednesday's session that deserves our attention, and I'll show you that as I go through the charts. Let's go back and talk about what happened. Right at the open, we had a pretty much flat open and prices chopped above and below the unchanged level, and also the daily pivot, which was at 47.73. As the day went on, we chopped sideways. We didn't get up to R1. We tried to go a little bit higher. R1 was at 47.87. And then we ended up closing slightly positive. So not a gangbuster day by any means, but still a positive day, even though when we look at the seasonality for Wednesday's session, it was more negative. We were up 1.14% on well below average volume. We are positive with the technicals, but we are still overbought, and we've been overbought for quite a while. But in positive environments, that's what can happen. A market can go, usually it goes extreme positive or overbought longer than when we see the market going down, we get to an oversold condition. That sometimes produces a bounce. Because we're shifting from this idea that inflation and interest rates are both more under control, and that's shifting over to a more market-friendly stance. Of course, we're keeping an eye on all the different geopolitical events. Some comments that we can make: we're still in holiday mode. We're seeing volume really dropping off. Price action is pretty slow. We are in that period now, which is called the Santa Claus rally or not rally time. And so far, it looks like it's coming along for that. This takes the last 5 trading days of 1 year and then the first 2 trading days of the next year, puts them all together. If they tend to be up, that's positive for the Santa Claus rally. And then we're also in a period of seasonal time, which is the January effect. And that's when we tend to see small caps and even mid caps perform well during this time. That seems to be in effect for right now. Wondering if that still can continue, as we still have 2 trading days left in 2023. The Dow as well as the NASDAQ 100 did go up enough to create a new all-time high for each of those indexes. And the catalyst for keeping things positive was attributed to an auction in 5-year Treasury notes. That was very well received. This ended up sending interest rates lower across all the different maturities, and that gave more support to stocks for them to go up a little bit higher. But our list is pretty long. When we look at the short-term overbought indications, we have our short-term ADX, the short-term advanced decline ratio based on 19 periods, the 20-period exponential moving average study, the Williams percent R, the CCI, just the 20. I had the 14 on here mistakenly in yesterday's video. The 14 is still not on the list, so just the one based on 20 periods. Our stochastics, the 9-period RSI, the 20-period boom indicator, and the PMO oscillator. And we still have a pretty long list when we look at our intermediate term overbought or extreme positive indicators. The main ADX indicator that we use, that is still extreme positive. Our 50-period exponential moving average study, we're still extreme with the standard deviations chart, the Erin, the PMO studies, the Sean trend meter, as well as the Chaikin money flow, and the boom indicator based on 50 periods, the balance of power, the RSI 14 periods, and the S&P 500 as well as NASDAQ 100 bullish percent index readings are very extreme. The new high, new low study based on 10 periods, and then our 19-day advanced decline ratio based on price and volume. Long term, we're still above the 150 and 200 period moving averages. We're still working through this same basic scenario. It's shifted from being is the Fed going to raise rates, back to the idea that it looks like the Fed could be done raising rates, and then off into the future, possibly as soon as March, they may be getting ready to cut rates. The dollar was down and interest rates were also down, and we dropped quite a bit. We were at 3.89% after Tuesday's session. We're at 3.79% now. So interest rates are really coming down right now. The 10 to the 2 and the 10 to the 3 month, even with this shift in interest rates, we are still inverted with the two main yield curves that we follow. Sentiment is still extreme. It did tick down a little bit from 79. It's still above that 75 level at 77. This is when we start to look at using this as a contrarian indicator. Doesn't mean it's going to happen right away. It may happen after the first of the year. It could happen in the next session. We're just keep an eye on that. Our trend is still positive. The ADX is still above its moving average. Both the short and intermediate term are above that 40 reading. The green line's on top, so we are positive. Our bias is positive with the up day, and the last number of days have been up, so our momentum continues to be positive. We didn't have any economic reports that came out in Wednesday's session. I do have one chart to show you that I got from Isabel Net. This is put out by Carson, and it might be a little hard to see this, but this is just what happens going forward when the S&P has 8 weeks in a row of upward movement. And that's what we've seen after this week that we just finished with. And going forward, it's pretty positive from here. So I think that a lot of folks are wondering, are we going to see some kind of a pullback after the beginning of the year? And that very well could happen. But when you take a little bigger picture look, we tend to be positive when we've already been positive before, coming into the end of the year as we start the next year. Looking at our intraday chart, it was pretty much flat. We went up a little bit, down a little bit. We chopped along the daily pivot and the unchanged level, tried to break up a little bit higher, never made it up to R1, came back down to the daily pivot, went sideways, and then saw a little bit of buying going into the close, and that gave us our positive close for the day. Here's our intraday chart where we're pretty much flat with the pre-market session. We chopped around during the cash session, and right as I started to record, we're up about 0.25% or so with the futures in the initial overnight session, but beware, that's many hours before the market is still set to reopen again, and anything could happen between now and then. We are seeing where value is outperforming growth. The red line is slightly above the blue line, and that's a point of concern when we look at our different charts, not only this chart, but also this chart. We ended up being pretty much flat when we take the S&P growth to value ratio intraday. Then our end of day charts where growth and value were the same. They were both positive, but one didn't outperform the other. Growth did outperform for the mid caps and also for the small caps. So that's somewhat positive. But when we look at our ratio for the S&P 500, we're pretty much chopping sideways right now. That is a warning sign that I've been talking about pretty much in every video. But mid-cap growth is showing some improvement. It was up a little bit more in Wednesday's session. That could be some underlying strength that we're seeing. It's not going up really strong, but it is more mirroring what the index has been doing since we hit that low. Keeping an eye on our trend where the ADX is still above the moving average. It's trying to roll over a little bit. We're very, very high. We're well up into the 50s now. We get extreme if we ever reach the 40 point. So that just shows you how extreme we are. The green line is still on top. However, it's still below 40. So that's somewhat not as cautionary in what it's saying. And we're kind of seeing that the short-term ADX is rolling over just a little bit. It's right on top of its moving average, and both of these are starting to come down. This could give us a little bit of a heads up that the trend could be weakening. Doesn't mean it's a reversal. We don't use this necessarily when we just look at the ADX as some kind of a trend indicator. We look at the green line and the red line for that. We just want to see how strong is the trend. It had been quite strong. Now, in the short term, it's starting to fall back a little bit. If we see that in the intermediate term chart, that will confirm the weakness of the trend. We do see volume really continue to drop off. we're still getting rather excessive with the positive side of things. When we look at sentiment, the VIX is starting to come down. We still see this average little bounce up with 2 trading days left in 2023. Is something like that going to happen this time? I'm not saying it will, but before it has played out like that. Where for right now, when we look at the Ulcer Index, which is another sentiment indicator that we look at, we're still very, very low with fear. We continue to drop with the line chart and the bar chart for the VIX, getting very low readings. And the volatility of the VIX, or the VVIX, it continues to drop and it's starting to go below the moving averages. We're keeping an eye on this. When we look at the VIX to S&P 500 correlation, we came down just a little bit with this reading. We have not gone above this dashed line yet. If we do go above that and start to come down, sometimes that could signal at least some short-term problems for the market. It could be short-term problems even if we come down here. We're just not getting an extreme reading above this dashed line yet. It may have topped out. Then this is the other thing that I wanted to bring up. The equity put call ratio, this is the daily chart, and it really spiked up on an up day. That's rather strange. We're starting to head into another holiday weekend where the market is going to be closing a bit early in Friday's session. We're going to be closed on Monday. New Year's, okay. Some folks maybe want to do some hedging ahead of that. That could be the reason for this, because they might anticipate some kind of geopolitical problems developing, or some kind of problem developing over the holiday weekend. In our equity put call ratio based on 5 periods, because of that big move up that we saw on the daily chart, we're starting to go back up with the 5-period chart as well. That's turning things a little bit more negative, but we have been declining overall. But when we look at our risk on to risk off ratio, we're continuing to go up, and this is showing some improvement. That's positive for the market. Our advanced decline line, we're just going to the moon here based on price. We haven't quite broken out above this previous high based on volume. And that's a theme that we're seeing in a lot of our charts. We are breaking out based on price. We're not breaking out based on volume. Sometimes that can be negative for price action. When we see volume leading price, that tends to be more positive and gives more power to some moves. We're going sideways with our 5-period, and we're actually starting to decline with our 10-period new highs, new lows study, but we did see a breakout of some new highs. We're not really seeing any kind of new lows being generated right now. So overall, this is still quite positive. In our short-term advanced decline ratio, that's the blue line. It's still extreme positive. The red line, it's not extreme yet, but continues to be positive. And accumulation distribution continues to look quite positive, but we're wondering, are we getting kind of far away from this moving average? If you look over the past year or so, we're farther away from the moving average than we've been in the past. The Chaikin money flow is also positive, but could be giving us an extreme reading. We've been camped out up here. This tries to measure what the smart money is doing, and they're getting rather extreme right now. We are seeing a bit of an improvement with our cumulative NYSE advanced decline line, and our regular advanced decline line is starting to break out above this previous high. Our other NYSE advanced decline line also breaking out above this previous high. So that's positive there. But we're seeing a little bit of a negative divergence here. We are breaking out above this previous high based on price when we look at NYSE common stock. But when we're looking at volume, we have not broken out above this shorter term high or this previous high here. It's still looking good, but we want to see this leading price instead of following price. When we look at our advanced decline line studies, we're still looking okay with the NYSE and the S&P. We actually declined a little bit with the mid caps, and we were pretty much flat with the small caps. Looking at our daily chart, we have not really decisively broke above this previous high that we came up to. We're still looking good here, and we're still above this short-term pivot level that may provide support. We're just not really moving up with any conviction right now, but we're certainly not going down. Then when you look at the bottom, we continue to really drop off based on volume. But we are still extreme in the 20, 50, and 200 period moving averages when we look at this moving average study. The Williams percent R is still extreme positive. Here's the CCI 20. Even though it's declining, it's still above 100. The force index, this could be taken as a little bit of a negative divergence. It's going down. It's positive, but it's below its midpoint and declining. Where we look at the stochastics, we're extreme in the short, intermediate, and long term. And we're still up in the +3 channel of our standard deviations chart. That is extreme positive. We're still looking extreme with our boom indicator study based on 20 and 50 periods. This is how far away are we from the respective moving averages. We continue to be positive with the 200, but we're looking a little extreme here. Some intermediate term charts, we're still looking quite extreme with the balance of power. We're positive when we look at the trend with the go, no-go system. We're kind of going sideways now with the highest high value, and I pointed this out yesterday. We continue to be positive, and we're above an advancing midpoint, but we're starting to flatten out a bit here. The TTM squeeze, though, is positive with the lighter shade of blue bars. The ease of movement is still looking positive and is above 0. The Arun indicator is still giving us an extreme positive reading. The green line, that's buyers, and that's pegged at the top. And the red line, that's sellers, that's pegged at the bottom. When we get a real high reading like that, that's what the oscillator tries to measure, is the difference between the two. And we continue to advance with the summation index based on price. We have turned back up more now with the summation index based on volume. We're also breaking out just a little bit above this previous high with the summation index for the NYSE, and barely breaking out above with the NYSE summation index based on volume. Look at the double and triple exponential moving average study based on 50 periods. So far as we've been going up, this has been providing support for the market. We are going higher with the Swenlin trading oscillator based on price, but we tick down just a little bit based on volume. However, both are still above 0. We're getting even more extreme with our price momentum oscillator. When we take the indicator by itself, we're extreme with price, and we're also just about ready to get extreme based on volume. We're not extreme with the PMO studies. When we look at the percent of PMOs that are rising, we're not extreme with the buy signals, but we are extreme with the PMOs that are above 0. And we continue to be neutral for the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR for the S&P. We continue to be positive with the slope oscillator, but we're above this green line, which is an extreme reading. The MACD is still above its moving average, also giving us what could be taken as an extreme reading. So with all of our oscillators, we're positive in the short, intermediate, long term, but we're looking pretty extreme when we look at all of these oscillators together. We're above all of the plotted moving averages in our moving average tree. We're still extreme and haven't really started to decline yet with the bullish percent index for the S&P. We're still looking more positive with the NYSE bullish percent index and not extreme. We're really extreme with the NASDAQ 100 bullish percent index. The Sean trend meter continues to be extreme positive. The Chaikin oscillator, it's no longer extreme. It's coming down slightly now. The money flow is starting to turn back up and it's not extreme, so that's positive. The ultimate oscillator also turning back up above 50, that's positive. The vortex, the green line is on top and advancing, that's positive. The Copic curve is positive. The RSI is extreme positive based on 14 as well as 9 periods. On balance volume is positive. We're getting pretty extreme with our 200 period simple moving average study for stocks in the S&P, also with the 50 period moving average study. I don't have any Fibonacci airline charts because we're in no man's land or we're currently above any trend lines that we've been following here. So we look at our chart variations with the Heiken Ashi looking positive. The Kagi chart is positive. The Renko is positive, and the 3-line break is turning back more positive. I don't know why this is long time. It should be long term. I put the wrong word in there. Anyway, with our long-term studies here, the 150 and 200 were above these red lines here, which suggests that we're extreme positive. You can look at other times when we had similar readings, and then what did the S&P do after that? We're still above this weekly trend line going back to the 1987 crash, and we're still continuing to go up a little bit higher here. We're just a little bit above the long-term trend line based on the NASDAQ 100. We are showing some improvement with the equal weight index, and that's performing actually a little bit better than the S&P 500. That's why we're seeing this ratio coming down just a little bit overall, as the broader market has been doing better than just the big mega cap stocks. But here's another concern with Dow theory. We're breaking out to a new all-time high with the Dow. We haven't even been able to come up to this previous high with the transports, and we actually declined on Wednesday. We did go pretty much sideways to slightly higher with the utilities, and the transports continue to underperform the Dow. That's another warning sign. The Dow is still looking pretty healthy and starting to go higher. The diamonds, though, still continue to be neutral with the Elder's Impulse system. We are starting to break out above previous prices. When we look at the NASDAQ, we are setting an all-time high with the NASDAQ 100, but we continue to be neutral with the Elder's Impulse system for the QQQs. Our momentum is looking more positive. We're above zero, first of all, and we're above the moving average and starting to turn back up. So that's more positive. And we did come back and set a new all-time high for the QQQs, which represents the NASDAQ 100. Small caps continue to show some pretty good upward movement here. They closed well off of their high, but we're seeing a pretty healthy bar pattern here. Another day or two, and we could see a golden cross for the small caps. We have switched over to neutral, though, for the small caps with the Elder's Impulse system. And we're above this resistance level now and looking a little bit better. But when we look at the RSI for the Russell 2000 small cap index, we are extreme, but we've been extreme for a while, getting close to a potential golden cross. Shorter term in the when we look at momentum, we are positive. The mid caps did generate a golden cross, so that's more positive and also starting to break out a little bit based on price. But we continue to be neutral for the mid caps looking at the Elder's Impulse system. The financial sector was up again and showing a pretty strong uptrend and breaking out above these previous price levels. The micro caps, my goodness, they're up almost 20% since the low we hit down here. They're up into the 118 range now, so that's showing some much improvement. The FANG index is still looking really positive. We're also breaking out and coming back. I think we set an all-time high here on a closing basis, but this is still looking pretty healthy. The dollar ended up being down, and we are seeing the dollar dropping off, and that's usually at the expense of stocks going up. Keeping an eye on interest rates, we did decline with the 10-year yield. We were up with the 10-year based on price. We're still getting a positive result with the 1 month subtracting the 3-month yield. That's kind of an anomaly that's been going on for a couple of weeks now. And then looking at our growth to value ratios, the Qs are outperforming the S&P. That's positive. But when we look at discretionary to the S&P, we're coming back down to the moving average, and large cap growth is underperforming large cap value. We've actually dropped below the moving average. And when we look at our other growth to value ratios, the large caps are not hanging in there. The mid caps are looking about the best, followed by the small caps. So we are seeing more improvement in those areas. We're still extreme with our 10-day average of the S&P 500 highs minus the lows. We're still positive when we look at the new highs minus the new lows across the broad market. We're positive with our 50-period new highs, new lows study for the S&P. And we're starting to get extreme and staying extreme with the stocks above their 50-period moving average for the S&P, the mid caps, and the small caps. That's the second day now that I showed these charts. And we're getting extreme with our 19-day exponential moving average of the advanced decline ratio based on price, and we're now starting to get more extreme based on volume. The S&P to utilities ratio is going up, and that often supports the S&P. The 2-year yield is dropping, which also supports the S&P. The Staples to S&P 500 ratio, it ticked up just a little bit, but overall it has been declining and giving support to the S&P. So what's our outlook for Thursday? We are still in holiday mode. Volume is dropping off. We're wondering, is the Santa Claus rally going to end up being positive? So far, it looks like it is. Are we going to experience a positive January effect? So far, we have been, as we get closer and closer to these windows closing in time. Don't really have any earnings to deal with now. It's a pretty slow week in that area, but we are still positive and quite overbought right now. We will get weekly jobless claims, the advanced international trade in goods, as well as retail and wholesale inventories, and the pending home sales, and then keeping an eye on all the different geopolitical events. And on Friday, we're going to get the Chicago PMI. Looking at seasonality, we're neutral to negative across the board for December 28th for the Dow, S&P, and NASDAQ. But we're wondering if the January effect is still going to continue where the small caps outperform the large caps, and that also benefits the mid caps. We'll be on the 19th trading day of the month. There's only one more trading day left to go, where we tend to see a bit of positive seasonality when we look at the green dashed line. Also, Carson has this going higher here, positive seasonality. We will be in Thursday's session, which in 2023 has tended to be positive more than negative. And then when we look at all of our different seasonal charts, we do look positive with this chart, the next chart, the next chart, the Carson chart, the equity clock chart, but we see a little bit of a tick down as we come into the end of the year. And then when we look at the NASDAQ, we're also positive seasonally, and we're also positive with the S&P 500. And we're wondering if things are going to mirror what happened in 1982, where it looked like there was kind of a good pattern going on here. In 1982 going forward, that ended up being quite positive for the market. We're wondering if the same kind of thing is going to happen this year. And then this is a newer chart where when we start to enter into an election year, that's the dark blue line. We chop around quite a bit during the first quarter of the year before we tend to see more strength later on in the year. So our scenarios, not going with the down one now unless you are super aggressive, but there's really no evidence of that in any of our charts. Yeah, there are some warning signs. There's some things that we need to really watch, but at the same time, we're just not seeing any price action that's indicative of any kind of a decline. Of course, that could change at any time. If anything, we still lean towards the positive side, even though we are extreme positive, and we're also looking extreme with our ADX charts, so that's not really helping some sideways strategies that you may implement. The warning signs, growth is just not participating here. Is this going to come back to haunt the market as we get into 2024? It hasn't yet, but is that something that could be building that when we get into the beginning of next year is going to come back and have an impact on the market? Also, for right now, the equity put call ratio is going up. We're wondering, is this pre-holiday hedging? And so it's just people being prudent about things. Is this because we're overbought and they're looking for some kind of a pullback? Or is this because of seasonality, knowing that we're in a positive seasonal time, but right near the end of the year, sometimes we see some downward movement to close out the year. And then this is another thing. The transports are negatively diverging from the Dow. Isn't really having an impact right now. Will it have more of an impact as we head into 2024? The Russell and the small caps, they still are technically negative, but another day or two, especially if they stay above those moving averages, they are going to have golden crosses. And then the 1 to 3 month short-term bond spread, it continues to be positive where it should be negative. Oh, and incidentally, when we look at that bond spread that I was talking about, I've been Googling that. Like I'm back over here. I kind of messed that up. I Googled that, and there's a lot of talk about this online when it happened last spring, and that was due to the debt ceiling issue that we were dealing with. I keep Googling it now, and I'm not even seeing any reporting about that. So that's why I say I'm not really sure what that means for this point. Here are the positive signs. Our daily special K chart is positive. The longer term equity put call ratio is still going down. The risk on posture is improving. Our oscillators are positive, but giving us a lot of extreme readings. The parabolic SAR and vortex are positive. The bullish percent index is extreme positive. The Kopit curve is positive. The Zohorchak method has been improving, but it hasn't changed anymore yet. Midcaps generated a recent golden cross. Small and mid-cap growth continue to be positive. Small cap growth is near the lower end of its range, where mid-cap growth is trying to break out of the upper end of its range. The financial sector is positive, and our new high, new low study for the S&P continues to be positive. So our conclusion, we're still positive but overbought. We can say that in the short and intermediate term, and even long term, because we have some of our longer term moving averages that are getting extreme positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.